G'day expats and welcome to another episode of Expat Chat, episode 81 today. And as per last episode, I'm joined with my co-host Mitchell Kelsey, who is one of our APAC specialist financial planners. We've given Brett the axe another week, haven't we, Mitch? Hey, how you
Yeah,
going, mate?
very well, thanks, mate. How about yourself?
Yeah, good, mate. It's obviously into a short week here in Australia. We benefit from the Easter long weekend, so we've been nibbling on some chocolate Easter eggs, and it's obviously a good time to reflect and catch up with the family over the next couple of days. Have you got much planned over the long weekend?
Not too much, just a bit around the house. My partner and I sort of moved into a new place maybe 5 months ago now, and yeah, still a lot to do. So still a lot that we want to sort of improve on. So yeah, we've got the 4 days off, so it's a good period there to sort of get stuck into something like that. So looking forward to that.
That's it,
How about
mate.
yourself?
Yeah, well, same boat. I mean, similar to you, moved into a new place, and it's funny. It's previously didn't have grass to mow. I haven't had grass to mow for about 4 years. It's amazing how quick
Yeah,
grass grows when it rains. Feel like every
that's
second
right.
week I'm mowing it. So it's one of those fun things. But outside of that, just catching up with family. But I mean, we love to digress away from the topics that we wanted to discuss today. So I thought today would be a good topic. There's a few actually topics we're going to cover today, and it's centered around the same theme of investing in the share market. And
Mm,
today's topic is mainly driven by a bit of feedback from some of our listeners wanting to understand what different terms mean and different areas mean. So I thought we'd cover that. We'll talk about some active investing, passive investing, thematic investing, smart beta testing. What the hell is tracking error? All
mm.
those fun things. Before we get into it, I'll just get the jingle out of the way. The quick little disclaimer, as always. I've had to write this one down today. So today's episode contains general information only and should be taken and consumed for entertainment purposes only. The information contained in today's episode is not a recommendation and therefore you should not be replied upon as any form of personal advice. God, that's a mouthful. Mitchell, I think I might throw that over to you next week if Brett gives us the axe again.
Yeah,
Mate,
I'll give
well,
it a go.
yeah, mate. Well, I mean, let's jump into it. So the
Yeah.
first one I wanted to talk about was investor returns versus investment returns. It's something that came up in my feed early in the week, and I think you saw it as well. But
Mm.
I mean, what's your understanding of that the difference there? I mean, investor returns are very different to what investment returns are.
Yeah, that's right. It's an interesting concept, and it's just sort of suggesting that sometimes there can be a gap there between, what a share market index might do versus what return an investor, like an individual investor, might be able to earn on an investment, for example. And the gap there is generally due to some potentially some behavioral mistakes in terms of how they've gone about investing. A common example in just plain terms is maybe a client is invested and then, taken money out at the wrong time. And then, they've seen that the market's sort of beginning to go up again, for example,
Mm.
and then they've sort of gone in at that point in time and sort of missed most of that uptick in the market, for example.
That's right. I really like how you put that behavior gap because you've just hit the nail on the head there. And um, investor returns versus investment returns. Ordinarily, no one is going to get the exact same investment returns as what you see on, say, an index or what you see
Mm,
on, say, a fact sheet for the performance of a managed fund. The reason being is because you're never going to enter at the exact same time in which that sort of fund was started. You're going to be maybe putting money in at very different times, which overall means you're going to always get a very different return to what's going to be on, say, that one page of fact sheet that sort of gets
mm,
distributed by a lot of those investment managers. The other fact is investor returns are ordinarily after tax. So, we're talking about dividends, franking credits, they're obviously played into that. So when you're looking at performance of an investment on the market, whether it's a managed fund or an ETF, we know that the actual return that you'll get will never be the same. And I like what you said about the behavior gap and how often we can make accidentally poor investment decisions, pulling out of the
mm,
market at the wrong time. I think probably the clearest example of that would be COVID. COVID hit back in 2020 and, a lot of investors that probably didn't have anyone that was coaching them in the background would have made poor decisions, would have hit the eject button, exit the market quickly. Oh,
Mm-hmm.
crap. Don't know how big the drop's going to be. Those sort of things. Those that actually stayed in the market and had the foresight and probably the ability to contribute a little bit more into the market at that time, they would have done really, really well. And it's something that we also saw last year. So there's a lot of different things. Behavior gap, cover it. Probably another one is, as you mentioned, DCAing. So dollar cost averaging. That's always going to impact the return, isn't it?
Yeah, definitely. And it makes up a big part of our job is financial advisors, that financial or behavioral coaching aspect.
Mm.
And yeah, just making sure that our clients don't make these sort of poor decisions based on emotion. And
Mm.
at the end of the day, we are humans. We all do get emotional, and
Mm.
it's completely normal for us to sort of react this way. And
Yeah.
sometimes it's just a case of speaking to someone, get that sort of I guess get the right information to sort of
Yeah.
talk them off the ledge. I guess you could put it in those terms, and
Yeah.
put it
Yeah.
in simple terms, and sort of rationalize any sort of decision that they're thinking about making, and
Mm.
yeah, help them make a much more informed decision, I suppose.
Absolutely. I mean, it really helps when someone is a long-term investor. They know that they're a long-term investor, and you have that conversation with you. Go, listen, let's zoom out. The money that you've
Yeah.
invested through your super, or super is probably the easy example. We can't touch super until we're 60. If we're mid 30s, mid 40s, even early 50s, well, we still can't touch it or do anything with it until we're 60, which might be another 10 years away. We shouldn't be overly concerned about what it's doing right now, because we know in 6 or 12 months time, it's not where it's going to be. It's going to be very different. History shows that off the back of poor share market performance, or a market correction, usually that
Mm.
share market is back up above the same level within 6 to 18 months. Worst case scenario, I think it's been 2 years. So, and that's going back 50 years when you look at the average performance of a major share market around the world, whether it's the ASX 200, the S&P 500, the FTSE 100, the Euro 350, the Asia 50, the list goes on. But mate,
Yeah, that's right.
let's move into another topic about different sort of investing concepts or themes and strategies. And it's mainly around investing in the share market. The first one that I wanted to just dive into a little bit was this concept of active investing. Active investing. What is
Mhm.
it, mate?
So generally, you'll associate active management with, I guess, a fund manager. So there's
Yeah.
a investment professional who is managing a portfolio of stocks or bonds, and his or her sole job is to sort of outperform an index or a benchmark. And
Mm.
essentially, that they deal in sort of active processes in trying to better beat the market. And
Hmm.
yeah, it might involve, I guess, a high degree of sort of moving in and out of different investments. There might be
Yep.
some more complex strategies involved in that process, such as trading in derivative securities,
Mm.
for example. So in a nutshell, that is, I guess, what active management is yeah, it deals with yeah, fund manager.
That's right. I mean, a lot of active managing comes from probably the asset class that we refer to as alternatives as well. There's a lot of
Mm.
short trading. There's a lot of derivatives options. Absolutely. Trading on the futures as well. Also, I mean, there's a lot of global active managers, Australian active managers. They'll either be trying to outperform a set index, like you said, ASX 200, all heard of it, or
Yeah.
sometimes they'll just say, oh no, our goal is to be 5 percentage points or 5% plus CPI. And God, that would have been a hard task last year. Holy hell. And that's a really good rundown. Why don't we talk about what passive investing is, or index investing? I mean, I think that's probably the one that gets a lot of attention, and most people probably have heard of it. Give me a rundown.
Yeah.
Passive investing.
Yeah, I mean, passive investing, it's generally associated with investing in the market, and it's certainly become popular in, I'd say, the last 5 to 10 years with the advent of ETFs, the exchange
Mm.
traded funds, which
Yep.
are essentially most people would know what an ETF is. It's a financial product that allows an investor to buy into a basket of underlying investments such as bonds or shares. And essentially with passive investing, I guess you do still have a fund manager to operate this ETF, but
Mm.
his or her sole job is just to buy and sell and hold the investments that make up, that mirror an index. And that index might be, for example, the ASX 200 or the S&P 500, so some broad equity market indexes there.
That's right. And that's where this concept of a tracking error comes from, where someone might say buy and invest in an ASX 200 ETF. You know, it's purely designed to mirror and track that index, as Mitch just put it. But the returns of that ETF will actually be a little bit different to what's on that ASX 200. And the reason for that is because of tracking error. That ETF will actually find it very difficult to be the exact same market capitalization of those companies at every given second that the market is open forever. It's never going to be the exact same. There's often a tracking error of anywhere between 3 to even 10%, which means that sometimes a ASX 200 ETF will actually outperform the ASX 200 and vice versa. The index will actually outperform the ETF. And that's a tracking error. It's very hard to deal with. You can't really do anything there to minimize it, to be honest, because of how quickly share markets trade, but it's just known as a tracking error. There's always going to be that little differential between what's going on in the major index versus the ETF that's meant to replicate the same index. So that's good, mate. I mean, probably saw a lot of it, I would say last year and when COVID hit as well, in terms of that tracking error. I mean, another good investing, I suppose, concept that I want to talk about with you is thematic investing. And sometimes you often hear a lot of investment managers talk about, oh, you know, key thematics have been working well. That's why, you know, our portfolio has done X, Y, Z the last 6 months. What is thematic investing?
So essentially, it's just looking to invest in a particular industry, I suppose. And essentially, I guess, again, I guess it is a form of active management as well, because, you know, a fund manager sees this particular sector as an industry that's going to perform well in the long term. And it's become something, I guess it's become something a lot more accessible, again, through the introduction of exchange traded funds by an ETF just looking to hold a basket of companies that have or that operate in a specific industry. So it might be rare metals, it might be, you know, cybersecurity, healthcare, all these particular industries. And yeah, essentially the fund manager or investors looking to buy into this space or this industry, they expect it has some really good long-term prospects. And yeah, it's again, generally it's going to have a clever sort of ticker name. I know that there's a few out there. So there's a rare earth sort of, or a climate environmentally conscious sort of ETF. It's got the ticker Earth, ERTH. Right. There's another one, HACK, HACK for cybersecurity. So those are, I guess, common examples of some thematic ETFs. I mean, it doesn't just relate purely to ETFs. There's sort of managed funds in the market as well. Right. And yeah, that's sort of high-level summary in terms of, I guess, a thematic investing style.
That's right, absolutely. And there's a lot of investment managers or institutional managers that do have those sort of thematics, and they're not really trying to replicate an index, are they? It's just sort of a case where they're focusing on that specific type of theme. I think last year when you look at probably themes that probably did really well, uniquely would have been probably there would have been specific commodity ETFs that just track, you know, specific types of commodities, which, I say they actually would have had a really, really strong year. But that's a really good rundown, mate. I mean, when you look at some of those thematics, they would have performed remarkably well in some areas, probably in the last couple of years. You know, even thematic where it's mainly focusing on rare metals or as you said before, earth. And then I've heard the most recent one that I came across was video games and esports, which, you know, that's a big theme, especially throughout the US as well as the European market as well, where it just seems to be going from strength to strength. So it is very interesting to see that. Another type of investing concept or strategy that we often do see related to either managed funds or exchange traded funds is smart beta. And for our listeners who haven't heard of it, don't worry. That it's pretty standard, to be honest. Smart beta investing. I mean, we're throwing out all these different terms, and as you can see, there's a lot of different ways and a lot of different strategies that a lot of different institutional managers follow. But smart beta, what's your feedback on that one, Mitch?
So I guess smart beta is it's sort of a combination of both active investing and passive investing, and generally the fund manager's job there is to still track it or sort of hold investments that mirror an index, a share market, a market capitalized share market index.
Yep.
But he or she might be making small tweaks to that portfolio just to try and outperform that given market. They're sometimes just referred to as enhanced indexes as well. And yeah, just trying to, I guess, in a different way to how active managers operate. They're just trying to outperform that index, but still by following the index to some degree.
Yeah, that's exactly right. I mean, it's an alternative index construction that they try and follow. The best example that I can probably give our listeners is there's a investment manager, Vanek, and they've got one which is an Australian equal weight ETF, which gives you equal weight to the 11 different general industry groups within Australia. So to make a comparison there, if you bought an ASX 200 ETF that replicates the ASX 200, that means that you are automatically going to have 38.50% exposure to the banks. And, next in line will be about nearly 30% actually to probably mining. And then you've got oil and gas, and then you've also got healthcare. So our Australian share market is heavily weighted to the banks, oil, mining, and healthcare. And then behind that, you've got obviously a lot of smaller ones. When it comes to technology and the ASX 200, it's not even 5%, very, very small. And probably the trend there is actually when tech companies get big enough in Australia, they head over to the US because the opportunities are a lot more vast. But when we compare the ASX 200 ETF to, say, that equal weight ETF, well, it means now you've only got, say, 10, not even 10% exposure to banks, and then you got 10% to mining, and then not even 10% to obviously healthcare. So that's the way it breaks it up. That can perform very differently to the way the index has been tracking. It might sometimes outperform, and then sometimes it might perform quite terribly. But that's what a smart beta one is. It's a very different index. It still tracks itself. Yeah, you go, mate.
No, I was just going to say it's very relevant in, I guess, the Australian equity market as well, because like you said, we do have that overexposure to specific sectors such as, financials and materials as well. So that's when, I guess a smart beta style of investing in a given market can be very, very beneficial and sort of help really diversify against that risk. So if we have, something that is going to, if something happens in the market or the economy that's affecting a given sector, such as the banking sector, as we've seen more recently, if someone is just invested in the ASX 300, the ASX 300 is going to be, it's going to feel that more than maybe an equal weight ETF, an equal weight ASX 200 ETF, for example.
Yeah, absolutely. I couldn't agree more. And I mean, that's why sometimes they absolutely, depending on an individual's strategy, investment strategy, having those kind of ETFs or funds, within their portfolio could be very useful. Absolutely. I think a lot of people that don't know how to access different fixed interests opportunities might opt for an ETF that invests purely in those kind of things. And it's very easy means, very easy to follow and buy a few units in an ETF. Absolutely. That's why a lot of people love them. I think, and I mean, we've definitely seen probably over the last 15 years that adoption rate really pick up with the use of ETFs, even big investment managers, rather than using and looking at direct shares for, say, international exposure, they might look to use ETFs. So I know we do a lot of that with our own portfolios, with our investment committee. But mate, that's been a really good wrap up for those different types of investing. I mean, last year we saw a lot of that market volatility and probably, unfortunately, a lot of probably mistakes made for general investors. In the last
Mm.
sort of 6 to 12 months, what have been some examples that you've seen?
Yeah, I mean, if we look at the calendar year of 2022, no doubt that was a tough year for most investors. I think you'd have to have been doing pretty well if you didn't sort of end the year, down in some parts of your portfolio. And, there's
Yeah.
in terms of, client experiences, I mean, we have a lot of clients, and as part of their sort of financial plan, we might incorporate a bit of a contribution strategy as part of that, where they're contributing to, their super account or an investment account on a monthly basis. And, during last year, we had those periods of, maybe 2 to 3 months where, we saw both equity markets and debt markets sort of fall heavily over the space of 3 months. Like there
Mm,
was some sharp falls,
mm.
no doubt some sharp falls last year. And naturally, as I said before, it comes down to that behavioral activities. And
Mm.
you have clients sort of reaching out and saying, Mitch, uh, does it still make sense to contribute this month? The
Yeah.
portfolio or, investments have come off a bit over the last 3 months. Should we hold off and wait until the portfolio is back? The portfolio is starting to lift again, and certainly still makes sense just to, stick to the longer term strategy, because, if we look back 6 months from now, and they contributed during that time, they're going to be better off, and we're not, necessarily as concerned over those shorter periods
Mm.
of time what the market is doing. We're always looking to the long term. So
Absolutely.
that's sort of a common example that I guess most financial advisors would have encountered something similar to this last year.
Mm.
But
Yeah.
yeah, what about yourself?
Well, I mean, it's a really good one you talk about there, and the the main theme there is dollar cost averaging. For our listeners that were or have worked back in Australia, probably the most common form of dollar cost averaging that happens to us without us realizing in the background is our super guaranteed contributions going into our super funds. That's automatic. It'll happen either on a monthly basis or a quarterly basis. And it's just going into our super fund. It's going into the set investment options, buying obviously into those investments at different times. And we don't really bat an eye and worry about it too much, to be honest. It's just almost on autopilot. And that's actually what a lot of successful clients have done. They automate and they're almost on autopilot with a lot of the ways they invest. Dollar cost averaging. Okay, well, last year I agree. The market performance 2022 was a shit year. I'm not going to sugarcoat it. It was a really terrible year. Bonds, they even corrected about 12%. The NASDAQ, the S&P 500, they were down. Um, Anyone that actually finished up, I mean, they're a prophet of the Lord, to be honest. They must have had that shiny ball and could see into the future. Let's be, but
Yeah.
those that were buying at different times, say on a monthly basis or quarterly basis, even if the market dropped a little bit and they were buying a little bit more, remember that's just getting better value for your money. And remember,
Mm.
if you're dollar cost averaging, it's probably a high chance that you're a long-term investor. So the returns on that money that you just put in, say 6 or 10 months ago, imagine what the return is going to look like on that select shares that you bought in 2 or 3 years' time. We're already back up. So, I mean,
Yeah.
it's a really good example of when dollar cost averaging works. I've got actually a really good example of dollar cost averaging. So I'm going on a holiday very soon over to Italy, and I've been tracking the euros very closely. One for my clients, and two because it's going to hit home when I head over there. So as of last year, from about September last year, each month I've actually been doing some dollar cost averaging of my own, been converting a little bit of Australian dollars into euros. That way, when it comes time to head over there, I'm not worried about the exchange rate at that point in time. I'm glad I've been doing it because right now, one Australian dollar is worth about 60 cents or 61 cents. Last year it was worth closer to 65 cents. By dollar cost averaging, I've helped smooth out and actually reduce, I guess, that overall currency risk. And if I convert it all now, I'd be getting a lot less value and bang for buck, I
Mm.
guess you could say. Um, I think a really good recent example for a client that came on about 4 months ago is probably the way the property market might be tracking, as well as interest rates. What are their interest rates on their mortgages kicked out from the juicy lean fixed rates of 2% to
Mhm.
variable being 5.5%. So through Jeremy, we did a bit of a review there. We actually pulled out some equity there in Australia. So what we're doing with them is we're doing a bit of debt recycling. And I'm not going to deep dive into debt recycling today, but all it means is pulling out a bit of equity out of the main residence home that you're living in, using that to invest in shares, using the dividends from the shares to put back onto the main residence debt. And you're getting also an interest expense tax deduction from that equity loan. When you do that over the long term, you should only do that for a minimum of, I would say, 7 to 8 years. It really helps increase, I suppose, overall your wealth, depending on the right returns. You're getting the tax deduction. So there's a really juicy tax return. Ideally, you're getting a little bit of a refund there maybe. But what you're doing there is you're converting your bad debt, which is your non-deductible debt, into good debt that's deductible. That all changes
Mhm.
if you move out and rent out the property. But that's a really good example of what we've been doing. A bit of a mortgage review on that one, property review as
Mhm.
well. Looking to buy another property, but also doing some share investing and a bit of a cleanup on the super funds. They had 5 super funds, so way too many there. Outside of
Too
that,
many.
yeah, way too many. That's it. All the insurance premiums. Oh yeah, they added up. That's for sure. But
Yeah.
that's an example of a recent client that we've helped. Outside of that, I want to do a quick shout out to all our listeners. We will be doing that property and mortgage and financing webinar online. Jeremy Harper, he'll be anchoring that one with Brett Evans, and they'll be doing that one on the 25th of April. So only a couple of weeks away now. In terms of the times, it'll be about 6:30 p.m. Australian time, or I suppose East Coast time. Now that we're no longer got daylight savings, it'll be about 4:30 Singapore, Hong Kong time, and I believe 12:30 p.m. Sort of Middle East time, Dubai time, Abu Dhabi time. So look out for that. We'll put the link in the show notes. Outside of that, mate, thanks for your time today on today's episode. I'm hoping we can get you back on the next episode, and maybe we just give Brett
Yeah.
the flick.
Yeah. Well, thanks for having me back on for, a second week in a row. Always enjoy our chats. And yeah,
Until next time, guys, thanks for tuning in. Speak soon.
thanks guys. Bye.